Hello, I'm Bruce Stout, and I'm the director of the Rainmakers Forum, and this is our Exit Your Business channel. Thank you for joining us. My co-host is Anthony Citrolo. Anthony, hello.
Hi, Bruce. How are you?
Could you please tell us a little bit about you?
Sure, Bruce. That'd be great. And thanks for hosting here. I appreciate it. Anthony Citrolo. I founded the NYBB Group. It's about 20 years ago now. We work with business owners who turn to us as advisors or intermediaries when a business sale needs to be transacted, and also when those owners are looking for their best exit solution. It could be a couple of years earlier than perhaps the time that they want to sell the company. We fortunately have a long history of helping those clients and those business owners with what may be their largest investment, optimize what their proceeds are in the sale, and we try to do that at the least possible cost, and also get those transactions done relatively quickly when they need to.
And Anthony and I are very happy to have today Joe Milizio. Joe, welcome.
Thank you very much. Appreciate
Tell us a little bit about you, and then we have a question for you.
Okay, sure. So I am the managing partner of Vishtik McGovern Milizio. We are a general practice law firm in Lake Success and Manhattan. I do general business representation, representing for the most part closely held businesses, everything from startup through exit and anything in between.
Okay, so we have a question for you as it relates to business exits and of course, the acquisition of those same businesses. So, Joe, how does an acquiring company address the issues surrounding contingent liabilities of the acquired company?
Sure. So there are a number of ways that a purchasing entity or an acquiring company can look at potential liabilities. Things along those lines are contingent liabilities, as you indicated, Bruce. And from inception, it would be a due diligence practice whereby the selling company or the target basically provides a lot of information to the acquirer. Usually lists are sent over requesting all sorts of documentation. But one of the main priorities as far as due diligence is concerned is to look at financial statements, which would obviously show liabilities. They ask for copies of any contracts or agreements which require expenditures in excess of a set number of dollars, and then they take it from there with their review. Once they review the due diligence material that's supplied, then the sale agreement or the asset purchase agreement is prepared, and it contains representations and warranties on behalf of the seller, such that other than as appears on a schedule attached to the agreement, there are no liabilities of the selling entity. And the selling entity would prepare that schedule, which is, again, attached to the agreement, which lists all of the liabilities so that the buyer knows what is outstanding. Now, obviously, in an asset transaction, liabilities are generally not purchased. So there is a distinction there between an asset sale and a stock sale. Acquirers generally are more concerned on the stock sale side because the definitive agreement will, in fact, cover various liabilities, things of that nature, and they want to be sure as to what liabilities they are taking on after the closing.
Joe, I had one quick question, Joe.
Sure.
We had so many folks, when we're doing transaction work, and the seller would like to sell it as an asset sale, thinking that he's going to have less tax liability, from a capital gain standpoint. The buyer really wants to do an asset sale. Sometimes we have to do a stock sale because of, different reasons. Maybe you could talk about when somebody needs to do a stock sale, and everybody seems to be very concerned over, how they protect themselves from any kind of vicarious liability.
Yeah, so a sale is usually contemplated when there are contracts or obligations that cannot be assigned by the target company to the purchasing company because of restrictions within the agreement or prohibitions, such as a real estate lease, as an example. Real estate leases usually provide that any sale of the business, that any sale of the business, could be deemed to be a assignment, which requires the landlord's consent. Now, other leases, other contracts don't have that provision at all, and both buyers and sellers look for that to see whether or not contracts have assignment provisions that would either allow or prohibit the selling entity from assigning. Generally, that appears a lot in government contracts, things along those lines.
So, Joe, I'm the acquiring company, and I'm acquiring stock for a reason that requires that. And the selling company doesn't give me a liability because it doesn't exist at that moment. But suddenly a suit arises because of an action done prior to the sale. What happens?
So there's generally an indemnity provision in the definitive sale agreement, which provides that the seller is obligated to indemnify the purchaser for any liabilities that should come up post-closing, and those liabilities would effectively be pre-closing liabilities, such as you just described, Bruce. And anything that might come up post-closing, the buyer is going to notify the selling entity and say, hey, we have this liability that you didn't tell us about. It is a contingent, or might have been a contingent liability pre-closing, but nevertheless, it's an actual liability at this point that the company is going to be responsible for in one way or another. And we are looking to you, selling company, to indemnify us for any loss or claim that we might have to pay. That indemnity is, at least in larger transactions, usually backed up by an indemnity escrow as well, that the buyer can pull from in the event of any kind of loss.
Anthony, a question for you. When a company is being acquired, what are the circumstances that would require a certified audit versus perhaps a compilation or something like that?
Good question, Bruce. We don't have a lot of companies that require a certified audit. I think if you find a large public company making an acquisition, they would want an audited statement. And I think it depends on the relative size of the company being acquired. It is a pretty costly process for somebody to actually go through an audit, especially if they've never been audited before. We do have some occasions, though, where both public companies or private equities could require an audit. Most of them really get reviewed statements for the most part, and probably without the audit, the diligence is probably a little deeper. It takes a little more time. It costs a little bit more money. We do see that happening on a regular basis.
Okay, so Joe, give us a couple of words of caution you would tell an acquiring company as it relates to the liability issue.
Oh my God.
Ask the same question over and over again, and make sure you get the same answer over and over again. Because just as for instance, I sat with clients last night reviewing the representations and warranties in an agreement. And when I asked them if the target was a guarantor on any third-party debt, they said, no, we have no guarantees outstanding. However, after further discussion, I learned that there was a UCC filing for the company, which I assume was a line of credit or a business loan. And it turns out that it was a UCC filing as a result of a guarantee for a mortgage that was given for an affiliated entity. And when I asked the same question again, they said, "Oh yeah, I guess we are a guarantor on a loan." So it pays to make sure that you are in fact asking the right questions and making sure you get accurate answers.
Got it. Anthony, final closing thoughts.
So, look, I think it's great information that we shared here. I recommend for my clients a couple of things. One, before they enter a transaction, have a good idea of what asset or stock sale means, because somebody like Joe is somebody you need to talk to so that you have an understanding of what you're going into and how you need to structure it. The second thing is look at a qualified CPA so that you know what the tax ramifications are, so that you're going in with at least a base of knowledge, as opposed to being kind of blindsided. And make sure when you hire somebody who is an attorney, and I say this all the time, Joe knows I say it, hire somebody who does work on business contracts, and not somebody who maybe practices most of their time in another area. And I think it's real important. And look at a tax specialist who really can help you. Maybe it's not just any CPA. It could be somebody who really is very deeply involved on the tax side, and it'll really make your transaction go a lot smoother, and also put a little more money in your pocket and protect you as well.
Good thoughts. How do people reach you?
So they can reach me very easily. I'm at the NYBB Group, Anthony at the NYBB Group. We're here in Melville, New York, and just search for me that way. It's real simple.
And Joe, your final thoughts.
I think what Anthony said is very on point. I often work with clients whose accountants admittedly don't have the expertise or the background to take them through a transaction. So they will bring on an accountant or an accounting firm that has the skill and the experience, and they only enhance the transaction both for the client and their accountant as well.
And how can people reach you?
I can be reached at vmmlegal.com. The phone number at the office is 516-437-4385. I am at extension 108. And my email is jmilizio, first initial, last name, at vmmlegal.com.
And if you'd like a copy of a special video report that was put out by Anthony's firm, please reach out to us at info@rainmakersforum.com. Gentlemen, thank you very much.
Thanks, Bruce.
Absolutely, Bruce and Anthony. Thank you very much.